SoFi is an extremely fast-growing fintech stock, earning 74% more money this year than last year. But while you've probably heard of their different apps like SoFi Money or SoFi Invest, they have a silent workhorse that powers every part of their business: lending. And while you've probably heard of it, you might not realize how essential to the company's future this is going to be. Hey everyone, and welcome to FinTech. In this video, I'm going to be doing an overview of SoFi as a company, talking about their overall business model, and doing a deep dive on one segment of their business, their lending segment. And while their number of users on their apps is way higher than their number of lending customers, lending is driving most of the company's earnings at $172 million just last quarter. So hit the like button if you want, and let's start with a brief overview of SoFi as a company. While SoFi is now a giant company with products competing in areas from lending to investing to payments processing, it was not always the behemoth that it is today. SoFi was founded in 2011 by 4 co-founders, including Mike Cagney, the then CEO of the company. Cagney was a former trader for Wells Fargo and had founded his own hedge fund prior to meeting his future co-founders at Stanford Business School. It was at Stanford that they decided to start their own company. SoFi started out purely as a student loan company, offering loans to graduate students across the US, but they soon branched out into other areas of lending, including offering home mortgages and personal loans. This greatly widened the number of customers SoFi could service and put them on the path to growth. They have since added new products to their lineup, including a credit card, their SoFi Invest app, and even a digital payments processor in Galileo, their technology platform. They are also one of the closest fintechs to obtaining a bank charter, already having approval from one of the 3 required agencies. But this growth from a smaller student loan company to a fintech company large enough to challenge traditional banks did not happen overnight, nor was it all smooth sailing. Early on, SoFi was plagued by accusations of a toxic workplace environment, and all of the co-founders except the CEO Mike Cagney left over the years to found different ventures. All this while SoFi continued to grow. The cultural issues came to a head in 2017 when Mike Cagney left the company amid accusations of harassment. He was then replaced by current CEO Anthony Noto, the former chief operating officer of Twitter, who also had experience as a managing director at Goldman Sachs and the CFO of the NFL. Noto has led the company into expanding into new areas, acquiring Galileo Technology Platform, an online payments processor that is powering everything from their cash management service to moving money in and out of their investing app. Today, SoFi has 3 main businesses: financial services, technology platform, and lending. Financial services is probably the area you're most commonly thinking of when you're a SoFi user. It includes SoFi Money, their bank account, SoFi Invest, their investing app, and the SoFi credit card, as well as several other products. This is the area where they are growing the fastest, although with relatively low margins, and it currently acts more as a top of sales funnel for the rest of the business. Their technology platform, also called Galileo, is a payments processor mixed with a somewhat independently operating company, one that was valuable enough for SoFi to shell out $1.2 billion back in 2020 for an acquisition, which leaves their lending platform, the original bread and butter of the company, and by far their most profitable area. But just because this is the oldest part of SoFi's business does not mean this area is not ripe for growth and absolutely essential for SoFi's future plans. So let's jump into some of the numbers behind SoFi Lending and talk about why this is so important. SoFi Lending is currently bringing in $172 million per quarter, which accounts for the majority of the company's total $237 million in total revenue. But despite already being a big segment of their business, lending grew 47% year over year this past quarter, with a lot of that growth coming from personal loans. A personal loan is a form of unsecured debt, where you give someone money with a higher interest rate than, say, a mortgage, but it is unsecured. So if they don't pay it back, you can't seize any assets to make up for it, which is why the interest rate needs to be higher to account for that risk. The personal loan market right now is still being depressed by the effects of the government offering money to people during the lockdowns. So once that pressure ends, I would expect them to see even more growth in this area. But while the lending market is still growing, it's not growing nearly as fast as some of SoFi's other segments. Lending products only went up 14% year over year to 981,000. Compare that to their financial services products like SoFi Money or SoFi Invest, which saw 243% growth to 2.6 million products being used last quarter. Or even Galileo, which grew 119% to over 79 million accounts last quarter. These ridiculous growth rates absolutely dwarf lending's. So why am I saying that this relatively slow-growing portion of the company is the powerhouse of the business? Well, it all ties back to SoFi's strategy going all the way back to their founding in 2011. SoFi started out offering student loans, starting with other people like the founders, graduate students. But as they grew, they decided to become a digital finance company, a fintech company. But why would a company choose to be a fintech? Well, there are two main benefits. You get universal access across the nation and potentially internationally, and you get near infinite scale. With SoFi's new offerings, we see them more and more embracing what makes a fintech powerful. They're developing new products in areas that can make use of the infinite scale of a digital company like their apps SoFi Money and SoFi Invest. This area of financial services within the company grew 7 times over the past year, and 2.6 times in just the past 3 months. That's not a 7% or a 70% growth rate, it's 600% growth in the last year. But all that growth only produced $17 million in revenue, so it's not contributing hugely to SoFi's bottom line at this point. So where does the real value of this growth go to? Well, it all comes down to bringing new users into the SoFi ecosystem. We can think of these financial services like a top of sales funnel, with the goal of grabbing new people and making them a part of SoFi. It doesn't matter if SoFi Money breaks even on their earnings, as long as it encourages new members to transfer to more profitable areas of the company, like SoFi lending. We see the same thing with SoFi's Galileo Technology Platform. SoFi is investing aggressively in helping this business scale, putting millions of dollars into moving their servers into the cloud, allowing them to scale much more quickly at a moment's notice. This is despite the fact that Galileo only brought in $45 million in net revenue last quarter, even while they processed $53 billion in financial transactions in the quarter before lockdowns. SoFi is clearly gearing up for explosive growth in these lower margin areas of the business. But the only reason they would bother doing this is if they had a plan to monetize all that growth. SoFi lending is that plan. But okay, you might say, sure they can use their financial services to bring in new customers, but couldn't they also just spend that money advertising their lending services directly? Why waste money developing products that don't make money? Well, to answer that goes one level deeper than just looking at SoFi's latest earnings. Yes, having users in their SoFi Invest app gives them free advertising for SoFi lending, but the real key is the SoFi ecosystem. SoFi says in their 10Q report every quarter that we are a member-centric one-stop shop for digital financial services that allows members to borrow, save, spend, invest, and protect their money. SoFi wants to be the one-stop shop for financial services. They don't want you to use them for lending, then go and use Robinhood for investing, and Ally as your bank. They want to bring you into their ecosystem and keep you there. And that word, ecosystem, should make you think of Apple, because I think that is a good metaphor for what SoFi is doing. A lot of people buy Apple products. A lot of people buy only Apple products. And it's not because every Apple product is the best in the world. It's because Apple's products work together better than stringing together third-party products. There's value in the Apple ecosystem itself. And I think financial services are the same way. If you have one account with a company, let's say a credit card, it's not that hard for you to cancel the card and go somewhere else. But if you have a credit card and an investment account, it's a little bit harder. But if you have a 30-year home mortgage with a company or a student loan, it becomes a lot easier to say, it's just a little bit easier to also bank with the company servicing my loan. And if I'm banking with them, well, maybe I'll use some of their other services as well. SoFi calls this the financial services productivity loop. They mentioned in their IPO investor presentation that they are building our products so that they are better when used together. Also explaining how they generate best unit economics from lower customer acquisition costs, that when combined with lower costs from vertical integration equals a win. One interesting idea that was brought up during an analyst question in SoFi's latest earnings report, which I did read through in its entirety so that you don't have to, was the idea of SoFi rewards. So maybe you buy something with a credit card or you hit a savings goal, and in return, SoFi gives you credits to buy cryptos or maybe pay down a loan that you have. I can really see how as the ecosystem grows and becomes better integrated, it could almost become like Apple's walled garden, where it's just easier to use other services within the company than going elsewhere. So okay, we understand how SoFi has been executing leading up until now, with financial services and Galileo driving most of the growth and lending driving earnings. And we also have a view into their long-term plan. But what about over the next few months? Is now a good time to invest? Well, there's two ways to answer that question. The first is just by looking at the numbers. After their last earnings report for Q2 2021 came out, SoFi's stock price dropped, possibly partially due to how they forecasted their earnings to grow going forward. They still expect some growth next quarter at around $250 million in revenue, but that would put them up only around 5.5% quarter over quarter. Meanwhile, they expect their EBITDA to drop slightly to negative $2 million at the midpoint. And for the full year, they expect the revenue to hit $980 million in revenue and $27 million in EBITDA, which would represent 38% growth year over year since 2020. That's not a super inspiring forecast, especially considering that that is the same forecast they issued 3 months ago, before beating earnings in their latest quarter by 9%. So basically they see things looking more bleak than expected in the back half of this year than they originally thought in the first half. At the same time, there is a lot of excitement around whether or not SoFi will soon obtain a banking license. They currently have preliminary approval from the OCC for a bank charter, but they still need approval from the FDIC and the Federal Reserve. If they get this license, they could simplify their regulatory structure to one national bank, rather than following a bunch of different state regulations. They could also do things like act as a sponsor bank for Galileo if they wanted to offer digital credit cards. So in the short term, there are pros and cons for investing in SoFi. It's not a 100% sure thing. What we do know, though, is something SoFi mentioned during their earnings presentation. The fintech space is going to be a winner-takes-most market. Similar to how Uber or Amazon came to dominate the space that they moved into early, SoFi sees one dominant fintech eventually pulling ahead of the competition and becoming the de facto choice for most users. For me, that's the real question with a long-term SoFi investment. Will they become the winner in this winner-takes-most market, or will they become an also-ran? They definitely seem to have the opportunity to become the AWS of fintechs. The only question is, can they pull it off when other companies are competing for the exact same thing? If you think the answer is yes, SoFi seems like a no-brainer investment. But if the answer is no, it's hard to see the stock price 10xing over the next several years. I personally currently have a small position in SoFi, but because of the uncertainty around it, I don't have the same faith in it as I do my other stock positions. But let me know what you think of SoFi in the short term and the longer term. Make sure you get your free stock from Public worth all the way up to $70 in the description below. Don't forget to like and subscribe, and I'll see you next time.